guys, this is Forensic Forex with Deontay, and I'm back in another video. This is episode 16 to the Asian Session Library. Here once again with the same pair UJ. Not to say other yen crosses can't work with this model, because I've never said that. They do work with this model. I just want your undivided attention and focusing on one pair, and it keeps things concise with me, so I'm organized. UJ, here Thursday, November 9th, 2023, we have another example for the model. Now, if you're unfamiliar with this model, you're new, all the other episodes are exactly the same. So it doesn't matter where you start. If you start from the beginning, the middle, the end, it's all going to be the same. I'm going to explain it step by step the same exact way. Now, with my personal due diligence and backtesting of the model, I believe Tuesdays and Thursdays stand out as the ideal days to trade this model during Asian. Now, many people say Asian session is not primarily a good session to trade, depending on where you live globally, but especially if you're using yen crosses, I believe it can be utilized still. This session is still a feasible session to grab a certain amount of pips out of it. And I think this model brings a full circle to that. Now, what we're using is the New York lunch session, which is 12 p.m. to 8 p.m. That's a dead zone. So it's a known fact within an FX full trading day, within this time period, price tends to consolidate. Now, there are times where it does spike up or trend up or down, but I know it has the characteristic of consolidating. Price tends to move sideways. You can see it does trend up, but overall as the session tends to progress, you can see price starts to concise. Buy side and sell side orders are building up, so that's sentiment. Retail traders are thinking which way it's going to break out, and we're going to be using that to our advantage. We're going to be counterparty to where people think the break is going to occur. What we're looking for is a false break on highs or lows, and how we find these highs or lows are resided by the swing highs. So these swing highs here, or mark it off in red, that's buy side liquidity. Now what a swing high is, it's a high point that has a lower high on the left and a lower high on the right. And I'm taking all the ones that are unbroken because that's buy side orders residing above it. Now we can also think about it as somebody potentially selling the market and having a stop order above those highs. Or if they were to go short, they're going to put their stop losses within that general area. Same thing vice versa to the sell side. So we have swing lows, which is inverse to a swing high. A swing low has sell side liquidity below it, and it's a point that's low and has a higher low on the left and a higher low on the right. And I'm taking all the ones that are unbroken as well. And this is on the 15-minute time period. Very specific. I'm just showing you exactly how I do it, because I know there's going to be people that come across a model and may tweak it, which is cool as well. But I'm just showing you exactly how I would do it and how I find success. You have the Asian session open. You know, anything above it, it's a premium. Anything below it, because that's the opening bid price, the starting price for the cost of the pair UJ at the start of 8 p.m. Now, once price drops below that price point, it's discount. That's ideal for buying. Once price moves above it, that's ideal for selling. But we want to see something happen while being in a discount. We want to see price break significant lows or short-term lows. So this swing low here, there's sell side liquidity below it. If we're going to go long, we want to see price break it and give us a lower time frame entry around these lows below 8 p.m. opening price to go long towards these highs. So a purge on sell side liquidity and a revert back to buy side liquidity. The same thing can be said inverse. A purge on buy side liquidity and then a revert back to sell side liquidity. Looking for some type of lower time frame entry on the 1 minute. I prefer the 1 minute to go short this way, or 1 minute to go long this way. Now, many people may ask, what about trend? Now, at times it does follow the daily trend or the higher time frame bias, and Asian can be the turning point for price to make a new leg higher. Like any other kill zones, London, New York, they also can be the turning points. I do think Asian tends to have turning points in moments and times where it does trend higher. And London and New York does not create some type of Judas swing. Asian is like the low of the day and it continues to trend. If we play price forward, you can see immediately price drops down quickly. At this point, we can think retail traders are going short. Immediately, they're chasing price at the drop. Larger candles are picking up, so they psychologically are probably invested, they're going short. Or on some type of retail logic, break, retest, go short. So they probably think price is going to go down, oh, come back, go short, which is a scenario. But what we're using for this model is we're using them as counterparty to go long since price went down. Vice versa, if they're going up and they're looking for a break, retest going higher, we would use that as counterparty to go short instead. So we're trying to be the counterparty to the trade. If they're going to sell to us, we're willing and happy to buy it at a cheaper price. Thank you for selling it to us, because we think within the next 5, 10, or we think essentially from 8 to 12 a.m., we think that it's going to either change in price significantly for us to make a profit. And at this point, we would think that here, we think it's going to gain value over time because it's dropping cheaper. Once it breaks that 15-minute swing low, I would do what? I would go down to the 1 minute. We can see it breaks 2 levels of the 15-minute swing lows. So that green highlighted area is the Asian session that we're currently in. And these are the 15-minute swing lows he marked off on the 15-minute time frame. And these are the 15-minute swing highs as well. I believe I marked this one off wrong. I may say, just double check. Yes, I did. I knew I did. I want to make sure everything is proper for you guys. So we go back to the 1 minute time frame. And what we're going to be looking for is some type of market shift. So we're waiting for a certain pattern, something that we all can recognize that happens over and over again, cookie cutter like. It has to be a certain pattern recognition that our eyes can see, and it results in some type of movement or gyration in the market, higher or lower. Here, those that are familiar with the pattern may say that this is where the pattern starts, but it's not true. What we're waiting for is a market shift on a swing high. This is not a market shift with a swing high. This is definitely a fair value gap for sure. You can see that there. However, these are not swing highs. These are double tops. So if you look at the H at the top here, when I hover my cruiser here, you can see the highs are the same. It's 151.271. Same thing here. Equal highs. Same thing here as well. These are equal highs. 151.273. Right there. Equal highs, equal highs. Price does not create a market shift. So we're still waiting for price to create some type of market shift. So let's play price forward. And we can see here, we got a market shift right here. The market shift is this swing high being broken with a fair value gap. You see price runs right through with speed. Not a very large one, but in theory, it's speed to the upside, causing a break of this swing high. There is that market shift there. This is the pattern recognition that I'm looking for. At this point, I would look to go long. Now, it all depends on your risk appetite. You're risking 1%, 2%, 3%, however you see fit. That you have to do your due diligence on. But this is the pattern recognition of where I'm looking to go long. I'm going to go long on the top of that fair value gap. Now, you could get fancy. You could go long at the top of the fair value gap, the premium side. The very first touch is the premium, the ending point of the fair value gap, or midway of it as a second entry, or right there at the discount, the very start of the fair value gap. You can go long here. But the easiest one is to go first touch. So as soon as price touches it, you're going to go long. What I like to risk is 15 pips for 15 pips, or 20 pips for 20 pips, a 1-to-1 ratio. Very ideal and very easy to grab. It looks like my Mac is dying. Let me just grab the charger. So very ideal for a 1-to-1. So I'm looking for price to trade into this fair value gap and then give me an opportunity to gain 15 pips, 20 pips, 30 pips. Minimalistically, 10 pips. Ideally, 40 pips is a great trading session. If you get 40 pips out of a session or out of a day, that's a good trading day. So we got there, that's 15 pips. So we measure that down. That's a 15 pip SL. Now, like I said, the risk that you're going to take all depends on you and your equity. Please do your due diligence or contact those that manage your funds. So here we're going to be looking for a 1-to-1. And we can see this 1-to-1 as well fits the range of where price could probably run. So this is the 15 pip increment up from where price is. It is also running those 15-minute swing highs. So it's an ideal, realistic reach for price. 15 pips up here to get to these highs. Those are the same highs we transcribed on the 15-minute time frame. Notice this market shift, as well as all the other examples, is happening where? In a discount, not in a premium. We're not buying in a premium. It doesn't make sense. It's ideal to you as a trader to buy cheaper. The quicker you come to that realization, the quicker you will be profitable as a buyer. And the same thing vice versa. Quicker you would understand selling in a premium is ideal to you as a trader. You take on less risk. It's cheaper to buy down here than it is cheaper to buy up here at this opening price. buy below the open, sell above the open. So if you buy down here, take profit up here above the open. If you sell up here, try to take profit back down here. Now, that's not going to be a everyday case scenario, but if something does align with what you're thinking, with your analysis, make sure it follows the lines of premium versus discount. You want to set yourself up for the best price trade possible. At this point, we play price forward. You can see we do go into some drawdown. But as time progresses, we can see price does trade up. We're trying to get back to fair value. So you can see price lowers all the retail traders short, while price then starts to buy it cheap and brings price back up to what? The buy side liquidity, that draw on price. What's available to the price? Those 15-minute swing highs there. So that's what we can see price running right back into. So we went cheap, right? We were up here for a second, but quickly sold off. We're cheap now at this point. What they're going to do? Accumulate orders probably for a couple minutes during the session, and then finally it lets it go and it flies. It spills over. All those that went short now have been stopped above highs. Anybody that's looking to go short, they've been stopped out. Now, there are cases in time where price does get up to those 15-minute swing highs and does produce a selling opportunity all within the same session. Comes down here, nice buy back up here, and then at times there's both ways being played out, and then another sell comes in. But here we can see it's one-sided, which is why I like to stick to one side of the market per session. I don't like to go in and double dip. If I'm being a buyer, I'm a buyer. I'm not going to go back in and look to be a seller. It throws off the psyche, and I want to be specifically on one side of the market. I don't want to be wishy-washy. I want to be very direct with what I'm doing and strategic. Now, at times, price does follow the high time frame trend with this model. And I think it tends to happen on those days as well, Tuesdays and Thursdays. Price tends to run for more than 30, 40 pips, 50 pips, 60 pips, maybe 100 sometime into other days as well. So if we were to go on the higher time frame, so we go on the 15-minute time frame now outside of the session, you see we got to those 15-minute swing highs. So purge, revert. That's all it is here for the buy setup. Now, it can follow the bias as well, the higher time frame trend. We've known that dollar was going to gain strength against Japanese yen. It's a no-brainer. Yen is the worst currency right now to date. Dollar is going to be sought after. And as we do speed it up, just for the video's sake, put it on a 30-minute time frame. And we can see as the days progress, going into next week, so that was last week, Thursday, going to this week, we can see price ran up more than 15 pips. That one-to-one turned into what? More than that. As you can see, we potentially got 60 plus pips. And you can see I logged that here for the tracking. So I'm only doing Thursdays and Tuesdays. And you can see that was the entry. That was the stop loss. Let's go back to it. Make sure that's right. The entry point is 151, 270. So I got that 270. And then the stop loss is 151, 119. 119. So that's how I would log it. And that's where you got the 10, 20, 30, 40. Each plus is 10 pips. So 50, 60. Now I don't do the 61, 62, but right now I just do it at the increment there. A whole number. So we got 60 plus pips, which is really great. And it all started with that one entry. See, with the 1 minute, you see much more data, right? It's a lot of cycles the market goes through, a lot of highs, a lot of session highs it breaks, a lot of session lows it breaks, a lot of accumulation, redistribution, reaccumulation, a lot of things happen, and it all started with this right here. So you got that entry 151, 270, stop loss 151, 119, and TP 151, 420. And you can see how price gave us 10 pips for sure, because this is 15 plus more than that. So hopefully this was insightful. Once again, the model doesn't change. It's been the same from the start. Besides the entry, before we used to say take the very first fair value gap that forms and I realized that wasn't really ideal. Now we take the first market shift that forms, and that was the very first market shift that formed here on the 1 minute time frame. Just to be clear, that's that market shift right here. That's that pattern recognition. You're looking for this right there. That's your recognition. Fair value gap from this candle's high to this candle's low. There's a gap in between it. These candles are not touching. It's one-sided. It's all buy side. Price needs to most likely fill in this inefficiency. This small fingerprint in price is what starts it. Now, that's not to say this is the best entry possible. Price is going to hit this and turn around perfectly on the dime. No, this is getting us very close to the truth. Peace.